Ladies and gentlemen, thank you for standing by. Welcome to Supercom's first quarter 2014 results conference call. All participants are present in listen-only mode. Following management's formal presentation, instructions will be given for the question and answer session. As a reminder, this conference is being recorded. You should have all received by now the company's press release. If you have not received it, please contact Supercom's Investor Relations team at GK Investor Relations or view it in the news section of the company's website, www.supercom.com. I would now like to hand the call over to Mr. Kenny Green of GK Investor Relations. Mr. Green, would you like to begin, please?
Thank you, operator. Welcome everyone to Supercom's conference call to discuss its first quarter 2014 results. I would like to welcome all of you to the conference call, and I'd like to thank Supercom's management for hosting this call. You should have all received by now the company's press release. If you've not received it, you can find it on Supercom's website. In addition, if you'd like to be added to Supercom's mailing list, please contact us. With us on the line today are Mr. Aryeh Trabelsi, President and CEO, Doron Ilan, CFO, and Ordan Trabelsi, President, North America. Ordan will first provide a brief discussion of the performance of the business in the quarter, followed by Doron, who will discuss the results. We will then open the call for the question and answer session, where Aryeh, Doron, and Ordan will be available to answer your questions. Before we start, I'd like to point out that this conference call may contain projections or other forward-looking statements regarding future events or the future performance of the company. These statements are only predictions, and Supercom cannot guarantee that they will in fact occur. Supercom does not assume any obligation to update that information. Actual events or results may differ materially from those projected, including as a result of changing market trends, reduced demand, and the competitive nature of the security systems industry, as well as other risks identified in the documents filed by the company with the Securities and Exchange Commission. In addition, following the company's disclosure of certain non-GAAP financial measures in yesterday's earnings release, such non-GAAP financial measures will be discussed during this call. Such non-GAAP measures are used by management to make strategic decisions, forecast future results, and evaluate the company's current performance. Management believes that the presentation of these non-GAAP financial measures are useful to investors' understanding and assessment of the company's ongoing core operations and prospects for the future. Unless otherwise stated, it should be assumed that the financials discussed in this conference call will be on a non-GAAP basis. A full reconciliation of non-GAAP to GAAP financial measures were included in yesterday's earnings release. And with that, I would now like to hand the call over to Ordan Trabelsi. Ordan, please go ahead.
Thank you, Kenny. I'd like to welcome all of you and thank you for joining us today. We are very excited with the results of the first quarter of 2014, our first as a combined company with our recently acquired Smart ID division. For some time now, we have felt really good with this acquisition, and as we saw both teams merge and work together seamlessly to achieve fast and effective results with our technologies, operations, existing customers, and new projects. Now we are happy to be able to demonstrate this with numbers which have surpassed our expectations, and this happened very fast. Within only 1 quarter operating as a joint entity, we not only strengthened our relationships with current and new customers, represented by several new orders, but also started realizing significant synergies with very high growth and operating margins. We achieved an EBITDA margin of 33%, higher than we expected to achieve so early on. Our EBITDA number of $1.8 million is at a rate faster than the 2013 pro forma half-year numbers, which were $3.1 million EBITDA for the first 2 quarters of 2013. This also means that already in the first quarter of operating as a unified company, we have successfully been able to bring the Smart ID division's profitability up to Supercom's level, a level which took us several years to reach since the launch of our corporate restructuring in 2010. It very much demonstrates the significant cost synergies of our recent acquisition and our capability to quickly turn a loss-making business in 2013 at OTI into a profitable one at Supercom. This is a significant and important capability of our team. We expect to be able to maintain an average strong margin profile throughout this year, but keep in mind that as new contracts come into play, there will be temporary shifts in growth and operating margins. With regard to the revenues, we do note that looking at Supercom, Historically, our first quarter is seasonally the weakest of the year. We do not expect 2014 to be any different, and we look forward to strong growth in revenue from this point during the remainder of the year. Our revenues in the quarter were primarily recurring revenues from our EID activities. Beyond these recurring revenues, we expect to see revenue growth this year coming from some recent contracts that we have won. Since the beginning of 2014, we announced 3 contract wins. In February, we announced a $4 million order from existing customers, deliverable in the first half of 2014. In March, we announced a $25 million in contracts with new government customers, with the majority of this revenue to be recognized in the second, third, and fourth quarter of 2014. I will add some more color at this point. This represents 2 applications with a new government customer who has a demand to deploy a whole array of new applications for their government, many of which rely on the same infrastructure from these first 2 applications. We are at an optimal point given our initial win and hence expect more projects from the same customer in the near future. Furthermore, as with any typical new EID project, around 20 to 30% of the initial bid is recurring and can generate revenues from 5 to 10 and even more years to come. In April, we announced 2 further contracts from an existing customer amounting to $3.6 million, which is deliverable in the second half of the year. Putting this all together, combined with our current base of $5.3 million of mostly recurring revenue, we expect strong revenues in 2014 with strong growth in the next 3 quarters. We believe our recent momentum has started to demonstrate the potential of our fast and growing pipeline of EID bids in many countries around the world. We have seen in the past that when these bids turn into contracts, they lead to continued and ongoing revenue, as well as further orders from the same customer. We are deploying new bids almost every month and are continuing to actively pursue a rich and extensive pipeline of bids, proposals, and leads. And we expect to receive new orders in 2014, more of them. I note that all these contracts are in the multi-million-dollar per year range, so even the win of 1 contract will have significant impact on our results. In summary, the merger with OTI's Smart ID division is going great, pushing Supercom even further as a strong, successful, and growing business with significant potential, much of which is still yet to be unleashed. We are well on the road to becoming a key player in our target EID and M2M markets, where we can leverage our rich and broad range of technologies and solutions. We have a vast breadth of EID capabilities globally, outstanding market and technology experts, and strong customer relationships, and look forward to continuing our performance throughout 2014 and beyond. I would now like to hand the call over to Doron Ilan, our CFO, for a financial summary. Doron.
Thank you, Odan. I will now walk you through our financial results for the first quarter of 2014, compared year over year with the first quarter of 2013, and after that we will be happy to take your questions. Revenues for the first quarter of 2014 were $5.3 million, well ahead of the $2 million reported in the first quarter of 2013. I will be presenting the rest of the financial results on a non-GAAP basis, which excludes the non-cash income tax benefit we had in 2013, as well as amortization of software and IP and customer contracts to intangible assets which were created as a result of the acquisition of the Smart ID division in December 2013. For the full reconciliation from GAAP to non-GAAP numbers, you can refer to the press release we issued yesterday. Our gross margin in the first quarter of 2014 was 84%, similar to the 85% we had in the first quarter of last year. Operating income in the first quarter of 2014 was $1.8 million, or 33% of revenues, compared to $653,000, or 32% last year. During the current quarter, we did not recognize an additional tax asset. However, we still had remaining NOL, and during the coming quarters, we will be reevaluating our profitability expectations, and we do expect that during the course of 2014, we will be able to realize further tax benefits. Net income was $1.7 million compared with $0.6 million last year. Earnings per share were 13 cents versus 7 cents last year. EBITDA for the quarter was $1.8 million compared with $0.7 million last year. And compared with 2013 pro forma, our current EBITDA run rate is ahead of that of last year. And on the balance sheet side, working capital at the end of the first quarter of 2014 was $5.5 million versus $4 million at the end of 2013. Shareholders' equity increased to $20.7 million at the end of the first quarter, up from the $19.4 million at the end of last year. With that, I conclude my remarks, and we would now be happy to take your questions. Operator?
Thank you. Ladies and gentlemen, at this time we'll begin the question and answer session. If you have a question, please press star 1. If you wish to cancel your request, please press star 2. If you're using speaker equipment, kindly lift the handset before pressing the numbers. Your questions will be polled in the order they are received. Please stand by while we poll for your questions. The first question is from Brian Abrams of Lazarus. Please go ahead.
Hi guys. Congratulations on the first quarter of the combined entity after the acquisition. Wanted to ask a little bit about the pipeline. Obviously, you realized some big contracts already this year, and I know you mentioned you've got a strong pipeline in the works. Can you give any additional color or context as to the number of potential contracts in that pipeline, the size of those potential contracts, how small or how big they can get?
Okay, thank you, Brian. In general, we cannot get into too much detail here, but we have out there, I think, over 10 different proposals. The size that can range from I don't know, $3 million to even $50 million, and they are in different stages. What we see is that part of the bid and acquisition that we were transferred from OCI Smart ID division together with the pipeline, we did from Supercom. We have right now some contracts or some proposals that are very close to the point of award. We hope that will be awarded, but we feel very good because the numbers of proposals being increased, the number of proposals we are putting out there is increasing every month.
I want to just clarify one thing. The 3 to 50 is on a yearly basis. A total bid size can reach up to $200 million in the current bids that we're interested in looking at in our target markets.
Great, that's very helpful. And I know you had hoped with the OTI acquisition that it would strengthen your positioning in these bids. Are you finding that that's starting to happen?
Yeah, I think there were cases that OCI and Supercom were bidding on the same bid. So because in the past OCI was probably the tougher competitor in this kind of bid, having both teams together, both from experience, references, and the platform, studying our position, we feel that our probability of winning bids right now increased by, I don't know, 200% if you compare it to Supercom as a solo company.
Great. You also mentioned that you're beginning to realize the synergies of the deal faster than expected. I think you also mentioned that the margins in some of these contracts improve over time. Can you give us any additional context on how you expect margins to change, improve, or otherwise in the coming quarters and years ahead?
I think that what you see in this quarter, we came very close to the gross profit. If you take the non-GAAP number for gross profit, we are now 85%, 84-85%, which is very close. In this case, it was easier because we took the contract as is with the people, and it's easy for us just to implement similar cost of goods. In the sales and marketing, we believe that we have some more cost to reduce there while we optimize our network of sales and marketing. And on G&A as well, we did not add a lot of cost or expense into our G&A. Structure was already lean. So we believe that from operating margin, the number that we have right now on the EBITDA of 33% is something that it's very, very high. We believe that we'll be able to remain in this range, maybe increase it to even 35%, but there may be some quarters, especially in quarters that we have a large contract to implement in the setup, that it may be go down to around 30%. So we believe that the margin that we expected in our plan to reach in the third quarter, we already reached in the first quarter, so we're very happy about it because the synergy came faster and we're working together and very nice from the first quarter as well.
Great, thank you. We'll step back into the queue.
Thanks, Brian.
The next question is from Deborah Fakis of Crystal. Please go ahead.
Yes, this is Deborah Fiakis with Crystal Equity Research. Thank you for taking my questions. Could you, if you mentioned this during your opening remarks, I apologize, I did not hear what your cash flow from operations was. If you could repeat that, please.
No, actually, we did not mention cash flow from operations for this quarter.
Will you be reporting that ultimately, or?
No, we did not report it, this one. The next quarter probably will report it.
Okay, just for the half.
Yes.
Okay, and then also the amortization of your intangibles that you listed in your EBITDA calculation, are those spread out across both cost of sales as well as operating costs, or are they exclusively considered among operating costs?
$150,000 are in cost of revenues, and the other $240,000 are under selling and marketing expenses.
All right, very good. From your opening remarks as well as the answers to the previous questions, it sounds like you're well on your way to integrating the OTI operation into the parent. Do you anticipate any additional costs related to bringing OTI into the fold, so to speak?
We do not expect any additional costs. There are some shifts, of course, that went into the second quarter, but we believe that by today we are almost there. We do not expect any additional costs from the OTI acquisition.
Okay, and then my last question is just in regard to your sales and marketing efforts. Do you anticipate adding new people, or are you satisfied with your current staffing and strategy for promoting and selling your products?
First of all, like in every organization, we are always trying to have the best people in our organization, so we are trying to have better people all the time, both in sales and marketing and in all the other divisions. But if we look at the merged organization right now, we believe that we have almost an optimal mix of people, both in sales and marketing, in the R&D, and in the other division. We will increase probably the number of employees or representatives in some other countries that we don't have the right presence right now. But in general, the way that our cost of structure is built, when we get a new contract, we just add more people that associate with the contract. So we see more changes in cost of goods, but we do not expect any additional expenses or cost to our G&A. Sales and marketing in general will be increased in accordance to the revenue, especially if we have people getting commission out of sales.
I see. Okay, thank you. That's very helpful. Thank you.
Thank you.
The next question is from Simon Fields of Echo Bay Capital. Please go ahead.
Hi, congratulations on all your success. The question I had for you was, during your prepared remarks, I think it was Ordan that was speaking, you were talking about follow-on orders that you expected to get from the $25 million acquisition, $25 million contract award you start talking about something over 5 to 10 years, and you throw out a 20 to 30% figure. Could you just slowly explain that again?
Sure. Basically, with this, we brought on a new government customer. They have a demand for several EID projects that could come into. It could be ID cards, voter systems, ticketing, passports. There's many different applications for an EID platform. Most of them rely on the same infrastructure, database, and registration. And we've already been selected for the first 2 projects. That means that our database and our technology will be there as the platform. That's why it's a natural assumption that the government will continue to work with us for many of the other applications, if not all of them. Many of these applications rely on the same infrastructure, and hence we hope to win, besides the $25 million announced, more projects from this specific customer. Now, regarding 5, 10, and more years, it's just in a typical EID bid, the first duration of the bid could be around 4 to 5 years, and out of the bid size that is announced, around 20–30% of that is a recurring element, which usually continues throughout all those first 5 years. That can proceed to 10 and even 19 years, as we've seen with some of our other contracts.
Okay, so you're saying, so of the $25 million, you're saying that there's a recurring 20 to 30%. There'll be an additional recurring element of 20 to 30% from that $25 million over, say, 5 years, and in addition, you're expecting additional contract rewards as a result of the initial $25 million. Am I understanding that correctly?
Just to clarify, out of the $25 million, there's 20 to 30% of that which will be recurring and continue to recur annually for the next years, and that's beyond the fact of actually deploying more systems, which can be of larger size and have both recurring and non-recurring elements to them.
Okay. And if you were to win additional sizable contracts after the $25 million award, typically how soon thereafter would you expect to win such a contract? And perhaps contract is the wrong word, but get an award.
How soon until we win new ones, if we do win new ones? Oh, it could.
I mean, if you're asking when we expect to renew, we don't really know, but it can be in the next week or in the next month. We are expecting some decision with some government that we are at the stage of last decision. So it can be, as I said, next month or in a week or in 2 months. It depends on how fast they're going to make their decision.
Got it.
The revenue from that will be, in most cases, it will be recognized almost immediately because we are prepared to work on this contract almost immediately once they're awarded.
Got it. Okay. Thank you very much.
Thank you.
The next question is from David Silverman of Eagle Capital Partners. Please go ahead.
Hi, thanks for taking the question, and congrats on a good quarter. And good to hear that the integration is going well. I just had 3 quick questions. So just to get back to the recurring portion of the 25, or the potentially recurring portion of the 25 million order. So if the 20 to 30% of that would be 5 to 7 million recurring, and would you expect the margins on that revenue to be in line with your company average, or would you expect it to be lower or higher? That's number 1. Number 2 was your R&D.
David, do you mind if we answer them per question, so that way?
Yep, no, that's fine.
Okay. To answer the question, our current margins represent a mix. Naturally, the recurring elements of the contract are of higher margins, and some elements of the recurring revenues are higher margins and some are lower, but in general the recurring elements are higher than new projects, which many times include installations and reselling of machinery and other hardware. But the mix right now that you see, our margins consist of a big part, majority of which are recurring revenues and some which are non-recurring. So to answer your question, yes, the recurring revenue should be a bit higher in margin than the average that you see for the company.
Okay, terrific. And then the second question was the research and development expense in this quarter looks like it was a lot higher than in previous quarters. And I wanted to know, is this the right level going forward, or was it associated with specific projects that you could talk about?
No, exactly as you said, this is associated with certain projects. Actually, a large portion of the expenses that you see in the first quarter are expenses that were capitalized last year in respect of certain projects to be won. And since these projects were won during the first quarter, we expense them during this quarter. So this does not represent the regular level that you should be looking forward.
The regular level should be around $500,000 per quarter.
I'm sorry, I didn't hear that. What was the number?
The regular level should be about $500,000 per quarter.
I see. Okay, perfect.
And then,
I'm sorry, just the last question was, on the ongoing capital expenditures for the business, what do you think an appropriate level of CapEx is to maintain your existing business?
We still continue to be very low, very minimal, and nothing material that affects the balance sheet or the cash flow.
Okay, terrific. That was all I had. Thank you very much, and congratulations.
thank you.
If there are any additional questions, please press star 1. If you wish to cancel your request, please press star 2. Please stand by while we pull for more questions. The next question is from George Mellas of MKH Management. Please go ahead.
Thank you very much. Congratulations on a great first quarter. Can you give us a little bit more color on the revenue, the 5.3? What portion of that was revenue, and maybe if there were different segments of the business that you can highlight?
Yes. At this point, we have not broken down the exact revenues of the quarter, but it's similar to our general business. 60–80% of it is assumed to be recurring, and some elements are not. We haven't given a specific breakdown, but it is currently in the typical line of business that we work. And that also includes 95% of which is usually EID and 5% in the M2M division.
Okay, great. And quick question on the $25 million project that there were several questions. Would that be the largest project and the largest potential project with additional applications that you or OTI has ever handled? And are you well structured and staffed to deliver on that?
First of all, I think that OTI, the Smart ID division, has contract with the size of $50 million in the past. We believe that this kind of contract can increase or expand to over $50 million in the future if we get more application. And we have some other proposal or bid that would size higher than that.
And we don't have a capacity problem to service this certain project. It's very much in line with the things that we've done in the past and have track records for. And as it grows more and more, we still have a lot of capacity to handle it without growing our fixed cost structure.
Okay, great. Thank you very much, and congratulations again.
Thank you, Coach. Thank you.
The next question is from Brian Abrams of Lazarus. Please go ahead.
One last question. Ordan, you mentioned the M2M division. I'm wondering if you can just elaborate a little bit on the initiatives there and your outlook for that side of the business going forward.
Sure. So on this specific earnings call, we have spoken less on the M2M division because a lot of what we wanted to show is the performance of the merger with the Smart ID division, which is part of our EID division as a company. In the M2M space, we have generally had a transformative business strategy. We went from components to actual solutions, and this has happened over the past year to year and a half. And now our our competitive and proprietary technology in the MTAM space is being united together with our capability to offer amazing solutions to customers. We've already served over 3,500 customers in the past with the technology alone, and now we're able to offer new capabilities which haven't been seen before by just a software or hardware provider on its own, but with someone who does both of them together. And that includes chips which can last a very long time in terms of battery life, have very long range, and are at a lower cost, but still have unique capabilities such as communicating with mobile phones and people's identities to offer a whole variety of different applications and offerings in the general Internet of Things space. We've already started launching pilots of these new solutions with large customers in the United States and other countries around the world. And soon we actually hope to announce and show our capabilities in conferences in the upcoming remainder of the year. This general division, the M2M space, has potential for very high growth. The general market by 2019 of Internet of Things projected to be over $300 billion for these type of services. We hope to address a certain part of that, and on a different presentation you could see more on that level. But we're excited about that as well, and hope to see that take a big part of our general revenue base within the next years.
Great. Congratulations again on the quarter. Thanks.
Thank you.
The next question from Tony Pollock of Aegis. Please go ahead.
Good morning or afternoon. You talked about a number 200 million. I didn't hear what that number was and what that meant. Could you explain that again?
Yes, I'll elaborate. Just in the past, we briefly elaborated that our addressable market, the general EID market, could be around $12 billion a year in revenues. We look at a segment which is a bit smaller. It's around 10% of the general market, and that's developing countries and bids up to $200 million. So most of the bids that we bid on are between $10 and $200 million. They usually are deployed over the course of 4 to 5 years, coming to a number of up to around $50 billion a year in the largest type of bids that we look at in revenues.
Okay. Do you have an average time period of the starting of a bid to awarding of contract?
In general, it can be 6 to 18 months. It depends on the type of process. But as I said, it can be up to 18 months. In some cases, even shorter. In some cases, also longer if there's appeals. In case that we have already an existing customer, when a customer asks us to add additional applications, it can be an immediate thing because in general, it's not going to the regular tender process.
Okay, thank you.
Thanks.
There are no further questions at this time. Before I ask Mr. Trabalsi to go ahead with his closing statement, I would like to remind participants that a replay of this call will be available in 3 hours on Supercom's website, www.supercom.com. Mr. Trabalsi, would you like to make a concluding statement?
Thank you. On behalf of the management of Supercom, I would like to thank you all for joining us today. I look forward to seeing you on the next when we discuss our second quarter result in about 2 months' time. Have a good day.
Thank you. This concludes the Supercom Limited First Quarter 2014 Results Conference Call. Thank you for your participation. You may go ahead and disconnect.